Beijing seizes control of Evergrande financial subunit amid contagion fears. Beijing, China, February 4, 2026. Chinese financial regulators, operating under an unprecedented joint mandate, today nationalized a core financial services division of the deeply indebted property conglomerate China Evergrande Group. The intervention aims to contain systemic financial risk amid escalating defaults in the nation's crucial real estate sector. The People's Bank of China, PBoC, and the China Banking and Insurance Regulatory Commission, CBIRC, issued a joint decree before Asian market opening, announcing the immediate seizure of Evergrande Wealth Management, EWM. A state-appointed stabilization team has assumed executive control, replacing the company's existing board and freezing its approximately 300 billion renminbi, 42 billion USD, in outstanding fixed income assets and investment products. Sources close to the regulatory bodies confirmed that the seizure was prompted by EWM's inability to meet scheduled principal and interest payments due this week, potentially triggering massive public protests among retail investors and creditors, and threatening immediate counterparty default across multiple smaller regional banks. The move marks the most aggressive state intervention since the crisis began, and signals Beijing's intent to impose order on the restructuring process rather than allow piecemeal collapse. State media outlets emphasized the action was targeted and necessary to protect the interests of retail investors while separating performing assets from the core property development liabilities. Global markets reacted sharply to the news. The Hang Seng Index fell 2.1% in morning trading, primarily dragging down infrastructure and material stocks, while bonds issued by other high-yield Chinese developers saw spreads widen significantly. Iron ore futures traded in Singapore dropped 3.5%, reflecting mounting concern over a protracted slowdown in Chinese construction demand. Analysts suggest the nationalization of EWM paves the way for a forced state-managed debt-for-equity swap for creditors, but raises critical questions regarding the security of offshore bonds and the transparency of restructuring proceedings moving forward. Regulatory officials have scheduled a press briefing for late Wednesday to provide further detail on the liquidation timeline and assurances for international bondholders.